Warren Buffett is massively selling off his stocks. If you kind of take a look at what he's doing, he's sitting on $300 billion worth of cash. And that led me to ask myself a very simple question. What exactly is happening? Why is he selling all of his stocks? Is he expecting another crash? If we can actually figure out what exactly Warren Buffett is planning, maybe that can actually help us in order to prepare ourselves for the next crisis. I mean, why would you sell all of your stocks if you think that everything is fine? Probably one of the reasons could be because he's expecting another crash. And who is better at investing than Warren Buffett? I don't think anybody can be called the greatest investor of all time other than Warren Buffett. He has been in the market for so long, and he has proved that he is one of the greatest investors out there. So let's try to understand in this video, why exactly is he selling all of his stocks, and why is he sitting in almost $300 billion worth of cash? Now, if you take a look at Warren Buffett's cash position, you will realize that now historically, back in 2016, he was sitting on $50 billion worth of cash. And that's a lot of money, to be honest, because there isn't many companies that can say that, you know what, we have like $50 billion in our bank account. But when it comes to a company like Berkshire Hathaway, which is an investing firm, and they are trying to invest in companies, it's very important for them to have a very large cash position. But if you compare $50 billion to what they have today, which is almost $300 billion, you can actually feel the difference. And we're throwing these words, but if you think about it, $1 billion is way more than you can possibly imagine. Like $1 billion is real money, and they are sitting on $280 billion of them. So historically, they actually try to increase their cash record since 2016, as you can clearly see. Yes, there was a slightly dip over here, but it wasn't insignificant. But over the pandemic, the cash position of Berkshire increased dramatically. But it wasn't just the Berkshire Hathaway. It was Apple, it was Microsoft, it was many other companies out there. And the reason they did that is very simple. When you have a crisis that is as big as the pandemic, you can't really plan the future. You don't know what is waiting for you. So in those periods, the best thing that you can possibly do is basically increase your cash positions, because you want to be as liquid as possible. Something happens, you want to know for a fact that your multi-trillion-dollar corporation that employs tens of thousands of people, probably hundreds of thousands of people, can operate even there is no revenue that is coming into the business. And if a big crisis hits it, you can restructure it into our supply chain. Because the moment the business stops operating and money stops coming in at that point, do you know what is happening to the business? The business is going to vanish. And building that business from scratch again is extremely difficult. And that's something that those companies don't want. They want the wheel to keep spinning. And that's why you want so much cash in the bank. But if you take a look at Apple's, for example, cash position today, it is not even close to Warren Buffett's. And take a look at what is happening over here. Yes, there was a dip back in 2022 when its cash position actually went down. But look what's happening since then. The cash position of Warren Buffett is dramatically increasing, and the biggest jump is happening right here in 2024. So ask yourself a question. Why is he selling all of his stocks? $280 billion is a lot of money. The reason you do that is because you're looking at the market and you're like, wait a second. If I know for a fact that the market is going to collapse at this point, shouldn't I actually sell all of my stocks? And when the market goes down, I'm going to use my cash and buy back those stocks at a huge discount. Wouldn't that make sense? In fact, Warren Buffett has been a big fan of Apple stock. And Apple is one of the greatest businesses out there. We don't have to go into the details of why it's such a great business. But even Apple, that Warren Buffett has been fan of, he has been actually getting rid of not all of his, but a substantial amount of his Apple stocks. Now, that doesn't mean that something is wrong with Apple, but it kind of indicates to us that Warren Buffett is preparing for something. He's getting the company ready for something significant and huge. Otherwise, he wouldn't actually change the entire structure of the business. And the wonderful thing, not the wonderful, I would say, the interesting thing about it is the difference over here. Usually when you have an investment firm, you have like 70 to 30, or probably like 80-20. Like 80% is invested in different kind of stocks, and then you have like 20% liquidity, or 20% of the entire portfolio is in cash positions in order for you to be ready for another opportunity that is going to come. But looking at these numbers, stocks represent just $309 billion, and cash represents $246 billion. It's literally like 50-50. Why is Warren Buffett keeping 50% of his entire portfolio in cash? Why did he get rid of so many stocks in the first place? That's a very good question to ask yourself. Now, in order to answer this question, we have to answer two different questions. Number one, what methodology does Warren Buffett uses in order to analyze and make his investment decision? And the second most important question is that what is happening to the market that has led them to think like that? So if we kind of combine these two factors together, we can try to understand and predict what might be happening inside Warren Buffett's head and what is his future plan. I mean, let's be honest. You want to know what Warren Buffett want to do, right? I'm not saying that he knows everything and he can for a fact predict the future or anything like that, because nobody can predict the future. I don't care who you are. The President of the United States, Warren Buffett, or some kind of a guy with an IQ of 4,500. It doesn't really matter. But we can actually try to be as accurate as possible. Like the more we know something, the better we are at something, the more accurately we can actually predict where that thing could potentially be in the foreseeable future. And that's what all investment is about. It's not about looking at the charts and trying to predict where the chart is going to be. There is literally an entire science behind investing. And the better you are at investing, the more you can kind of analyze the business and know where that is going to be. So the way that Warren Buffett analyzes a company before making an investing decision is beautifully illustrated in this little chart out here. I know that's a very simplified way to actually talk about it, but trust me, it's as simple as that. So any company that you want to invest in is basically a business. So it's a business. And that business is, for you, if you are, for example, an owner of that business, it represents the entire world. If you're a politician, it's a sort of taxing that business and a source of revenue. If you're an employee, it's a place for you to work. But as an investor, we don't look at businesses from that perspective. As investors, we have an entirely different perspective. We look at businesses as sources of cash. So yes, it's important, the products that the business is building, the CEO and the vision that it has, but all we care about is that how much cash does the business, how much real cash or free cash flow does the business can produce right now today? And based on our estimates, how much more of this cash is the business is going to produce, let's say 5 years from now. So let's take a very simple example. A business has 1,000 customers that buy their subscription for, let's say, $100. So 1,000 multiplied by 100, that's $100,000, and the business makes $100,000. And let's say a year from now, 12 months from now, we expect the number of subscribers to double based on the metrics and numbers we have. So the business is going to make $200,000. So it's very simple. So business is going to make more cash, and now it is going to be bigger and it's going to worth more. So there is a difference between something we call the price and the value. Price is the price of the company that is traded in the stock market. Now that price could change because we have something called demand and supply. And the value is what the real worth of the business is based on the money they're making, based on its future expectations and the growth rate. So these are two different things. If you're good at investing, if you know the numbers, if you know the system, if you have the right tools and you have the right knowledge, you can actually take any company, dig down its financial statements and find out its true value. You take that true value, you compare it to the stock price that it's being traded in the market, and then you find out whether it is being traded above that price. So it's traded above that price, then it's an overvalued business. If it's being traded below that price, then it's an undervalued business. It is being traded closer to that price, then it is fairly valued. But the important thing is that now, based on our analysis and our tools and system and knowledge that we have in place, how much possibly the business can make in the future. And that is basically the entire point. If you kind of predict the future value over here, you can potentially predict its price, and then you can actually make a very good investment decision. Of course, you might say that, well, who can actually predict the future? Nobody can do that. That is understandable, but there are factors that makes predicting the future much easier. And these are the factors that Warren Buffett all the time uses whenever he picks up an investment. Now, let's take a look at some of them. One of the things that Warren Buffett looks in a business is that he wants the business to be as simple as possible. So the simpler the business, the easier it is for you to predict its future. Now, I'm going to give you a very simple example to illustrate the point. Take Apple. Apple is the most successful company in the world, and it actually makes some of the best products out there. But if you take a look and place all of the products that Apple makes on this desk that I have right in front of me, they will be placed on this desk. Everything from their MacBooks to iPhones to Apple Watches, iPads, and that's pretty much about it. And then they have some services out there. Now, compare that to another tech giant, such as Samsung. Now, if you take all the products that Samsung makes, they wouldn't even fit in this entire room. They probably wouldn't fit everywhere because they have like 12,000 types of smartphones. Then they have like 500 types of TVs. Then they have fridges. Then they have coffee machines probably. I don't really know if they have a coffee machine, but I wouldn't be surprised because there is everything, every technology out there, and Samsung has a product there. Now, that makes predicting the future extremely difficult. Maybe as a business, it's pretty easy, understandable. They have the entire infrastructure to make it. I'm not saying that is entirely bad. But think about it. If you're trying to think and predict the situation of the business in the future, then the more products they have, the more difficult it is to predict its future. Now, compare that to Apple. Apple has, iPhone is its flagship product, and it represents almost 60% of its entire revenue. And if you can predict where that product is going to be 5 years from now, you can basically understand where the business is going to be 5 years from now. Then they have, of course, MacBooks and Apple Watches, but they make substantially lesser part of their revenue than the iPhone. And that's why Apple is a simple business model. The second most important component is the repetitive products. Now, repetitive basically means, in simple words, that people buy that thing consistently over time. It's not like a one-time product. Like, you have businesses that you buy things once and it's over, and that's pretty much about it. And you want to invest in businesses that have clients who come back consistently to buy that thing. Because if you have clients that consistently come back, you can predict its future revenue. It's as simple as that. Now, take Apple, the exact same thing. Apple has a lot of subscriptions. They have iCloud, they have Apple Music, they have X, Y, and Z. I don't know whatever subscriptions they have, but they have a few subscriptions. And now they created one single subscription, which is called Apple One. So if you have a certain number of people that use that subscription, you can actually predict that that's at least that much money the company is going to make next year. And if they can actually increase the number of subscribers, then you can expect that number of revenue to be increased. So it makes predicting future revenue much easier than if it wasn't a subscription. And that's why if you look at the world today, everything is being turned into a subscription. And I mean everything. It started probably with streaming services back in the day, but today everything is a subscription. Even a car today, I'm not really sure, but I guess there are places where you can get a car for a subscription. But you can get probably like your fridge even on a subscription basis, your streaming services, every single application that exists out there, or every single, whatever you want to buy, there is a subscription today, I think. And we have so many types of subscriptions that I can't really list all of them down here in this video. And that's a great thing because businesses realize that that is the best and the easier way for us to predict our future income and build a reliable business model where we know how much money we're going to make. Now, the third most important component is, of course, the brand name. Brand is what makes people come back and buy that thing. Why? If you have two identical shoes right in front of you, one of them has the logo of Nike and the other one doesn't have, I can tell you with full confidence that a lot of people, the vast majority of people, a big share of those people will go and take the one that has the Nike, even though it's actually priced higher. Because there is confidence that is built. There is trust that is being built between the client or the people in general, and that brand. And that's why brand is extremely important. Whatever Apple produces, people immediately trust that and they want to buy it because they just trust that brand. These are three important things that makes predicting the future much easier if you want to analyze a business. And if you take a look at the list of the companies that Berkshire Hathaway is investing over here, you will realize that all of them are following the exact same patterns that we just talked about. Now, we talked about Apple. It's very simple. It has a very simple business model. It has all of its products are very repetitive, where people just keep coming back for them. And then you have a very strong brand name. Apple is one of the most popular and the strong brands in the world. But let's take another example that is not related to Apple. Let's take an American Express, which is one of the largest holdings of Berkshire. Think about American Express. What products do they sell? Their main product is the credit card that they sell and their subscription on their credit card. I don't remember how much does it cost, but it's basically a subscription. Period. It's one product, they have it, which is a credit card. They have an X amount of people that is out there, and it's not really difficult for you to predict where that business is going to be 2 years from now, 3 years from now, because everybody knows it's a very simple business model. People want to spend money, people need a credit card, and they can get for a subscription that kind of a credit card. Now, second thing is that it's repetitive. Again, it's a subscription. Now, of course, they also charge interest on their credit cards. That's another their main source of income, but these are two probably main sources of income that they have. And it's repetitive, which means that we can actually predict how many people, how much revenue the company is going to make every single year. And if there is a track record of how many clients, by how many clients they increase every single year, we can actually expect or know for a fact how much money this company is going to make 3 years from now, 5 years from now. And because of this simple business model that is based on a subscription, we can anticipate its revenue. And when we can anticipate its revenue, we can find out its future valuation, at least based on the numbers and the facts that we have on the ground today. And the third most important thing is, of course, the brand name. Now think about that. American Express, it's the most popular credit card out there. Amex, it's like a luxury thing to have. If you're a rich person and you don't have like a credit card from American Express, it's a shame. I'm not saying it's a shame. I'm just saying that they have built a reputation of being the most popular and the luxury credit card company out there. And that's why they are following the exact same patterns that Warren Buffett absolutely loves. And that's why these businesses are successful. Investors love these businesses and everybody invests in them. I mean, let's just take, for the sake of simplicity, another example such as Coca-Cola. What is Coca-Cola does? Think about that for a moment. What does Coca-Cola sells? Coca-Cola has a very simple business model. They're selling a drink. And a drink is what? Is it complicated business? Like, they have a single product. They don't have any other product. They're selling one product, which is a drink. And yes, they also have Coca-Cola Zero, which is a second drink. And time to time, they might come up with a seasonal drink out there, or a classical or the original Coca-Cola. But overall, it's one product, a drink that satisfies and fulfills one of the basic needs out there. Is it repetitive? Well, it's not a subscription. You can buy one Coca-Cola, or you can not buy them, or you might not buy them at all. But people who drink Coca-Cola, it's very addictive. It has this type of ingredients that attracts people. And that's why people who drink Coca-Cola drink it consistently. Like, there are people who drink a few cans a day. So that makes it repetitive. The third most important thing is, of course, if we kind of find it out, it's a brand name. Tell me another brand name that is more popular than Coca-Cola. I don't think anyone can do that, because Coca-Cola is a unique brand that has been built over the last, 70, 80? No, it's over 100 years old. I don't really remember for a fact, but Coca-Cola is one of the oldest brands out there. It's probably almost 200 years old, if I'm not mistaken. If you kind of dig into the numbers, if you Google that out, you'll find that out. And if you look at the entire portfolio of Warren Buffett over here, you will realize that all of these businesses, and these are not all of the businesses, there are much more than them. I've just listed some of them, or the most popular ones. You will realize that all of them follow the exact same patterns as these three that we have discussed over here. That's exactly what how Warren Buffett looks at companies, and he tries. Of course, we can go into the details of how he analyzes the companies, how he finds out the undervaluing value of the business, but that's a story for another video. Now the question we want to ask ourselves is that what does he expect from the market at this point? What exactly is he behaving in such a way? Now the interesting thing about it is that the more money you have, the less opportunities you have in the market. And I know that it sounds very confusing, but think about that for a moment. If I'm going to pull out $1 million from my bank right now and I'm going to buy a stock like Apple, it is not going to have any kind of influence over the market or the Apple stock overall. Maybe the stock will slightly jump, slightly maybe, but it's not going to be a significant jump at all. And now compare that to an example. If Warren Buffett is going to use $100 billion to buy Apple stocks, that is going to shoot Apple stock to the roof. So the more money you have, the harder it is for you to maximize the returns on your investments. If you have $20, $30, $100,000, $500,000, a few $1 million, it's not going to have much impact. And that's why you have a lot of opportunities in the market. You can buy those. I mean, if you're really good at investing, if you know how to find undervalued stocks, you have like the knowledge and the tools right in your hands, you can actually make a 50% return, 100% return, 200% return on your investment. But if you're there with so much cash and your company is worth like $1 trillion, I think Berkshire is worth something around $1 trillion, and you have like $300 billion worth of cash, you don't have much options. Yes, of course, if you take like a few hundred millions of that money and invest it somewhere, but overall, you're not going to have a decent return based on all the wealth that you have in your business, because Warren Buffett has built Berkshire Hathaway over a very long time, and he has a very good track record. And if he suddenly starts investing in businesses that aren't going to support that track record, I don't think he would be happy with that, because he's like almost even 100 years old, or maybe older. I don't really know. He's probably like 95. And that's why with more money that he has less opportunities in the market. And that's why it's much easier, much difficult for him to actually find a really good investment. And that's why Warren Buffett has developed this very simple rule of investing that he has been abiding to since he actually got into the stock market. And that rule is called don't lose money. Whenever you are not sure about anything, don't spend that money, don't waste that money. Because if you actually waste money and you lose money in the stock market, it's much more difficult than to actually be patient and learn first. And let me give you a very simple example. If you have just a hypothetical example to illustrate the point. If you have $100 and you, let's say, lose 50% of that money in the market. Now, you lost 50% and you lost $50. Now, you have $50 in your pocket. Now, in order to get back to exact same position that you were before you made that mistake, you have to make 100% on those $50 just to get back to where you have been. That's why Warren Buffett has a very simple rule. Don't lose money in the stock market. So be patient, learn a little more, invest in yourself slightly, like be ready, like don't rush. Because the people who win in the market are the most patient people, the people who actually spend enough time in the market without making any rash decisions. But the most important thing is that he's very uncertain about the future. When you make predictions about the future, the easiest way to actually make a prediction about the future is to have something we call stability. When you have stability, you can use stability and take the factors on the ground that you have today, and based on these factors, because you have something called stability, you can actually predict the future. That is how you make any accurate prediction. But if you look at the world today, you kind of see that we don't have stability at all, not in the United States, not across the globe. We have wars everywhere, we have conflict in Europe, and Southeast Asia is about to enter probably another conflict. I don't know what's going to happen with China and Taiwan, that's a completely different story. But if something happens over there, I can expect for a fact that there is going to be a disruptions of global supply chains. China is the second largest economy in the world. Half of the world, if not more than that, depends on China as their largest trading partner. China is the holder of the largest treasury bills of the United States, probably the second largest. I think number one is Japan, but I could be mistaken. That could actually be easily Googled and verified by Google very easily. And that's why he's not sure about the future. He doesn't know what is waiting for us in the foreseeable future. And when you're not sure about the future, when you don't know where the world is going to be, especially when we had the pandemic and the United States global dominance is in jeopardy and in a huge danger, we don't know what's going to happen. So imagine you are this giant multi-billion, not a multi-billion, you're a $1 trillion corporation and you have so much cash and you have very little option because you can only invest in large companies in order for you to make a decent return. And now the future, and these large companies operate globally all across the globe. And if something happens across the globe, it is going to impact those companies. Then that's why you can't make any predictions about these companies. And when you can't make these predictions, what do? You keep your money. You start gathering, just keep cash, because something happens, you at least have cash and you haven't lost that money in the first place. But most importantly, if you know something about Warren Buffett, he's a very opportunistic person. He wants to take advantage out of the opportunity. In peace times, you can actually make an investment and you can make money. But if you make a good investment in an opportunity in a crisis, you are going not to double your money, but you can make 5 times your money, 10 times your money. And Warren Buffett has a pretty good track record of actually taking advantage of crises. Now let's go back to 2008. In 2008, Warren Buffett invested $25 billion. Well, that's not, of course, as much as $300 billion or $280 billion, I would say. But that was 2008 when the US GDP was down by, it was like $14 trillion during those days. And Berkshire Hathaway was much smaller company than it's today. And even though that it has been significantly smaller than it's today, it has been playing a very important role in saving a lot of these banks. And that's why he has invested $5 billion into Goldman Sachs. Now, $5 billion is a lot of money, and it was probably one of the greatest deals he actually got in the world of investing, because it wasn't just about this $5 billion. Those $5 billion meant that Goldman Sachs will pay Berkshire Hathaway 10% dividends for a certain period of time, probably for the next 6-7 years or something like that. Now, you see, there are 2 ways to make money in the stock market. One is you are buying stocks and the value of your stocks go up. Now, when the value of your stocks go up, you have made money on paper. You haven't made money in cash. Like those, you don't have like real cash on the ground. You can't take those money and you can't basically go and buy something. Unless you sell your investment, then you get your capital gains and then you pay taxes on that capital gain, on those capital gains, and you make money. But when you get dividends, that means that the company is going to send you a check for an X amount of money. When it comes to Goldman Sachs here, it was a 10% dividend yield, which means that with a 10% dividend yield, Goldman Sachs was paying Warren Buffett $500 million every single year, just cash, sending him cash. He's still an investor. He still owes all of those stocks, but every single year, Warren Buffett is going to get cash from Goldman Sachs, $500 million. And the interesting thing about it is that since then, the stock has grown substantially by 600%. I don't really know for a fact how much of those stocks he's holding today, but the fact that he made such a deal was one of the best decisions he could possibly make. Now, the second, not the second, but one of the other great investments he has made. I can't really give you all the investments he has made because this video would be significantly longer than it's already now. But he invested $3 billion in General Electric with the exact same deal. And that means that General Electric was actually paying Warren Buffett $300 million every single year, plus the value of those stocks since then has grown by 400%. Think about that for a moment. Look at what kind of great deals he has made. Now, he couldn't have made those deals if he didn't have that much cash before getting into the business. And $25 billion is just part of it. $25 billion is the money that he has invested. In order for him not to first of all, he must have enough cash in order to survive his own company and the companies he has invested in. And then on the top of that, he must have enough cash to actually take advantage out of the next crisis. So he knew that there is a crisis storming and he was preparing for himself in order to take advantage out of it. And that's why the crisis hit and he made billions of dollars out of that crisis. And if you take a look at Berkshire Hathaway since 2008, they have grown, I don't even know, they probably have grown like 10 times or something like that. I think I have to check the stock price in order to figure that out. And that tells you that if you want to take advantage out of the next crisis, if you want to profit just like Warren Buffett is now getting ready for the next crisis. He's not just randomly sitting on $280 billion. He's been massively selling off. I don't know when exactly expect a crisis. Maybe the end of this year, maybe the next year. I don't know. Like, you can't predict those crises. Like in 2008, people predicted the crisis for a few years and then boom, it happened in 2008. So based on what we have on the ground right now, the market seems very uncertain. And if you want to prepare yourself, start educating yourself, start learning, and start saving cash, because cash is what is going to allow you when the crisis hits to take the best advantage out of it. Thanks for watching and have a good day.